All right, guys. So welcome back to class. Um, so once again, we're going to be diving into inventory because the whole process of this accounting class is learning the basics and learning bits and pieces of specific areas of accounting. So in this case, we're looking at a merchandising inventory, right? So, merchandising inventory. Well, what is merchandising inventory? It literally is when we make already produced products, and our intentions is that when we purchase those already made items from the manufacturer or from the wholesaler themselves, we're actually going to either purchase them and we're going to package them in a way that represents us or represents the company. And what we're going to do is our intention is we're going to resell that product out to the public. All right. So basically, the trend here is that we're going to be converting cash into goods, right? And then we take those goods and we turn it into sales. And then at the end of the day, when we sell our items, they become back and convert back into cash. So once again, we are looking at a typical business such as a real, a retailer or a wholesaler. So we're going to be looking at either selling in large quantities or selling at an individual level, right? We're selling out to the public. All right, now let's go ahead and talk about what inventory includes. All right, so the definition that we take a look at when we look at purchasing inventory is that it's going to be every single cost it takes to get the asset to the store. All right, so what are these key factors that we're going to be looking at? Number one is going to be the purchase price. How much is it going to cost you to purchase that item, right? Then we also have other separate costs such as freight cost, shipping and handling cost. Sometimes if you're looking at a specific store, they could possibly charge you sales tax, right? But most cases you are sales tax exempt because you are a smaller business. But once again, that will depend on which business you're purchasing from. They may charge you the tax regardless, but most cases it is sales tax exempt. You have to do freight expenses, storage expenses, any foreign policies. So there's a lot of different costs that can be involved from shipping an asset and making sure it gets to your store. So the idea here is that when we calculate our cost of the asset, right, we need to include everything that makes that gets the asset to the store. Because what we're going to do is when we take a look at chapter 6 is what happens is that once we figured out what that cost is in order for us to sell the product, right, we need to make sure that the selling price includes the actual total cost it takes us to bring the asset to the store. So you definitely want to make sure that you include that because once again, you never want to be outing your own money or separate your expenses to get the asset to the stores because then your selling price might be just too low and you're never going to make a profit. So our goal is to make sure that when we do sell these items to the public or items to our customers, we want to make sure that the customer can cover all the costs it takes to get the asset to the store plus a small percentage that we're going to earn as profit. Okay, but here this is the things that we're going to be looking at. Now, for this class particularly, I'm not going to go super extensive in other costs to take to get the assets to the store, the most one that we're going to be primarily focusing on is going to be the selling price and freight cost. So shipping cost. All right. So just a little FYI there. However, that does not mean when you walk out to the real world, that does not mean all of these extra costs are not, I want you guys to know that they do exist. All right. And that they could be part of your cost of your inventory. Okay. So then we're going to talk about how shipping works. Okay. This is very important, especially when we take a look at who owns the items and who pays for what. Especially when we're looking at shipping, all right? There's two types of shipping. FOB, which is freight on board, okay? Usually freight on board is where the company, they have their own delivery services, so they ship those items out to you directly. Where we have, and then we also have COD, which is cash on delivery. Most common businesses, they usually have a third-party vendor that delivers the items to your store, and because they're a separate company that's separate from the actual business itself, they may charge you, a bill that they expect you to pay either right then and there, or they will send it to you so you have to pay just so then they can ship the items to you. So that's just the real difference there. But however, they do exist. They are two separate things. All right. You can have a freight on board that is a separate company from the actual company that you purchase your inventory items from. However, most common ones you would normally see separate would be your COD, all right? And this do exist today, all right? Now, let's talk about how we view and how the items get from one place to another, okay? So, when we talk about shipping point, all right, or in this case, it's also known as shipping origination, all right? So right now, the asset is at the seller's store, right? So when we purchase it, right, we are responsible to pay for the shipping from the seller's store all the way to the midpoint, okay? That's how shipping works. It's always split into two. Even though they make you pay $16 for shipping, it's a two-way thing. So one portion the seller pays for it, and the other portion the buyer pays for it. So in this case, when we're talking about shipping point, all right, or FOB shipping point, we're talking about getting the asset from the seller's store to the midpoint, and that makes us responsible to pay for the shipping between the selling store to the actual midpoint. All right. So right now, the owner or the seller still has they still own it. Okay. Then we're going to talk about FOB destination, all right, this is where the midway point comes from, and then it makes it to the buyer's store. In this case, the seller is fully responsible for making it from the midpoint all the way to the actual buyer's store, okay? So for instance, right, Amazon. All right. Amazon, the minute that you purchase an item, you're expected to pay shipping right then and there. Okay. And that's going to make it from the buyer's place all the way to the midpoint, right? And once the midpoint happens and then it transfers ownership to you, right, and the item gets shipped to your store, the seller is responsible to pay for that shipping, okay? So most oftentimes, right, when you lose your package or someone steals it or it just never arrives your store, who's responsible to have to pay for it? The seller is, right? You call and complain to the seller, I never received my package. They come and say, well, hey, I'm sorry, you never received your package. So they usually refund your money and or they'll ship you another item. So that's exactly where, if you apply it like that and understand it like that, that's exactly what's going on right here. All right? That's getting from point A to point B to point C. All right? So transferability of ownership does happen between the midpoint to the locations. But oftentimes, if the seller is responsible for FOB or destination, if the buyer has not received the items, there is no ownership of the items because they never received it, right? So that's how we have to kind of understand this, right? Any questions here?
No.
Now we're going to talk about the two different inventory tracking methods, right? So in this class, we are going to learn both methods. However, I'm going to split these methods into two parts. So then we can learn one way first, and then we will learn the other way later, okay? However, I do want you guys to be aware of both of them and what they do, at least like the basics of them. So the first one we have is called periodic inventory. All right. Just exactly how the word looks like. Periodic does actually mean occasionally, right? You don't look at it very often. It's occasionally. All right. And that's exactly how you're going to treat your inventory. Usually a good aspect of a periodic inventory is that usually at the end of a given period, you are going to be doing a physical count. All right? And that's where you're going to determine how much you actually have or considered as remaining in your inventory. All right? Whereas perpetual inventory, just exactly what its word says, right? Its definition of perpetual literally means constantly, right? You're constantly updating your inventory every time you make a purchase and every time you sell your item, because you are frequently checking it all the time. You can also take a physical count at the end of the given period, but you should be aware and know exactly how much you have at the end of every single day. All right? Or every time you sell an item. So, and this one, right? You don't need to take a physical count as like I've mentioned before, because at the end of the day, right, when you sell your items or when you purchase your items, you're keeping a really good track of inventory and making sure that when you do keep track of it, you are aware of exactly how much you should have in your inventory at all times. All right? So that's the difference between the two. One is you don't check very often. You usually check it at the very end of a given period. Whereas the other one, you're constantly checking it up. Okay? Now, here's also another major difference between the two. Okay? One is that we treat it like they are expenses. Okay? So, for example, here for periodic, we treat as purchasing our inventory as if they are expenses. All right? And because we have that little physical check at the end of the given period, that's where we have to understand that we must convert our expenses into inventory. Okay, at the end of every given period. All right. Whereas perpetual inventory, right? We see it, we purchase it, we view it as inventory, and it goes straight to inventory automatically. Okay? So, for today, we're only going to be focusing on periodic inventory because periodic inventory, it's much harder to kind of understand. But if you think about it this way, think about what kind of item you're planning on selling. If it's something that you're not really selling often, or it's not your main item that you sell in your store, use periodic inventory. But it's something if it's something that you're constantly making purchases of, constantly selling, it's one of your top selling items in your store, then you may want to consider perpetual because the idea of you always keep on selling that item, you want to make sure that you have enough inventory in your warehouse to be able to sell those items to the public. All right, so that's a huge difference. There is one of them. Maybe you don't sell as often. You don't care to keep track of it. So therefore, in this case, I won't keep track of it often because I don't sell it as often. So it isn't something necessary that I need to keep track of at all times. So that's going to be periodic. Once again, we're going to be taking a look at purchasing inventory as an expense. And once we reach at the end of the given period, that's where we're going to need a conversion entry to go ahead and convert it into actual inventory item, right? Convert it into an asset, right? So any questions here? We're going to go ahead and dive right into periodic.
So if I understand correctly, during per se a month, you can have both types of inventory on your records,
Oh,
correct?
absolutely. It depends on what kind of item you sell.
Okay.
So yes, you can use both. Now, but you can't use both for one type of item. Okay.
Okay. It has to be.
Yes, it has to be like multiple items that you sell, and you choose which one you want to be.
Okay.
Okay.
Thank you.
Mm-hmm. All right. So here we go. Periodic inventory. Right. So here we're going to take a look at how we make our purchases of inventory. All right. So here's the example. On July 1st, XYZ company purchases 100 units of toys, okay, from Toys R You, okay? And each toy costs $5.65 each, and freight costs $100. Purchases were made on an account. Okay, record this transaction. So here, once again, this is a perfect scenario where I'm only asking you to recognize two things: purchase expense and freight expense. All right? Because when we purchase our inventory, we're purchasing them as if they are expenses to the company. All right? So here are the two that we'll see, all right, in this class: purchase expense and freight expense. All right? And the one key here thing is that now we're also going to be practicing the word on account. All right? So let's go ahead and apply it here. Now, if we take a look at our accounting model, right? We are increasing our inventory. However, because we're treating this inventory as if they are expenses, right? I am increasing my expenses because I'm purchasing inventory, right? I'm making more expenses than I am lowering them. So in this case, I need to debit my purchase expense and also debit my freight expense because that's how you increase expenses. Usually you increase them on the debit side. And the key word here is because we placed it on an account, therefore I owe this vendor money. So therefore I'm going to credit my accounts payable because I'm increasing a liability. And we increase liabilities on the credit side. All right. So when we're taking a look at exactly how we're laying out our foundation here, right? If we have a purchase expense, a freight expense, and an accounts payable, how much am I going to put in each account? So what's my purchase expense amount for and what's my freight expense amount for?
The purchase expense is $565.
Good. And my freight is
$100.
100. So in grand total, how much do I owe Toys You?
$565.
Don't what about my freight?
What? Oh, and your freight. How much do you owe in freight costs?
In general, if
$665.
$665. So here we recognize that purchase expense. Purchase expense is going to be whatever you paid for. It's going to be the cost of the item, its selling price to you, right? So in this case, my cost was $5.65 multiplied by the 100 items I purchased, right? Gives me a grand total of $565. Now, of course, when we talk about freight, freight here is going to be separated, but it's actually going to be part of the cost for the overall inventory, okay? So, but in this case, I want to separate it just so then I can see what costs were associated to purchasing the item itself and what costs were associated for the freight expense. But at the end of the day, we're going to include it as the overall cost per item later on. But in this case, I'm recognizing $565 plus $100 freight. So therefore, I'm going to owe the company Toys U in grand total $665. Right? Any questions there? All right, I'm assuming that's a no. No questions? All right. So once again, when we look at this example right here, this is what we're going to be practicing for the rest of the class, is that here we recognize that we're making purchases of inventory. And this is exactly how I journalize it, is that I'm going to separate each expense. But when I create my cost of the asset, right, or the total cost per item when I sell my items, I will include all the expenses together. So in this case, this is it. This is how you journalize your first when you make purchases of inventory. I want you to recognize purchase expense, freight expense, and however you paid for it. All right. So, of course, when you make purchases of inventory, oftentimes vendors will give you what's called some kind of discount or terms. So in this case, when we look at terms, right, it will look just exactly like this. 2%, 15, net 30. Now, what does that even mean? And this is how you actually interpret this exact terms. If you pay within the first 15 days, you will be able to take a 2% discount. If not, the whole bill is due or needs to be paid within 30 days. So once again, this gives you as an incentive to pay back quicker. Now, oftentimes when you're looking at a vendor to a customer relationship, the purpose of this is purely for one thing and one thing only. They do not want you to out their payment. They do not want you to to um to say I can't afford it or can't pay them back. So what they do is they kind of give you an incentive to say, hey, if you pay me the whole thing in 15 days, I will give you an incentive and give you a discount off of your purchase items. All right? And usually this happens when you have a good relationship with your vendor and et cetera, et cetera. When your vendor trusts you and you made payments with them, or if you're a frequent customer of theirs, you always keep buying more and more inventory items from them. Usually they'll be like, you know what? Hey, you've been doing good. You've been making payments every time you purchase items from me. So I'm going to give you terms of 2% if you pay within the whole bill in 15 days. But if not, the whole entire bill is due in 30. Okay. Now, this you're not obligated to have to give terms because terms could just be net 30, right? I'm not going to give you a discount. However, I just want you guys to recognize that this can happen to you as a vendor to customer relationship. If you're purchasing inventory items, you can take advantage of this offer or this incentive, because at the end of the day, what you're essentially doing is you're paying off your liabilities. The vendor guarantees their money within a shorter period of time, and by doing so, they will grant you a discount. Now, this can also apply to you if you're the store, you're the owner, and you have your own customers. You can use terms for both customer to vendor relationship or vendor to customer relationship. All right? So, this can be applied for both purchases and sales. Okay? However, for today, we're only focusing on just purchases and purchases only. So, if your vendor decides to give you terms, this is what it should look like. All right? It should be straightforward 2% 15 net 30. All right? 2% 10 net 20. Whatever agreement that you guys made, usually you sign an understanding agreement. But most cases, a lot of bills are often due anytime between 30, 60 to 90 days. Some even go for 120 days. But you know, it just depends on what your vendor is and what that company that is selling the items to you for. So it's gonna just depend on that. Okay. And that's what I just want you guys to familiarize yourselves with terms, because it will apply for the next concept. Okay. Now, of course, when we look at purchase discounts, the one thing that we need to note here is that there are two different methods that you can record a purchase discount for. All right. We have the net method, and then we have the gross method. Now, it just like how you have a paycheck, right? You understand when you have a gross pay, that's the money that you've earned completely without taking taxes out. Where your net pay is going to be your end result after all the taxes, all the deductions, all the benefits are taken away from your paycheck, then you have what's called a net pay. That's exactly what this concept here is as well, right? When we're looking at the net method, we're understanding that what happens is that you're going to be calculating a total amount based off taking the discount right away. All right? You're going to include that as part of the purchase price. And what you're going to do is that's the end result that you're going to assume that you've already going to pay them off on time and that you will meet that discount date and you will get that discount. All right? So once again, net method is usually for more experienced accountants, okay? Because they're able to, calculate the discount right away. But not only that, but it's also for the major businesses that have the money to be able to just pay them off in like within those days, right? They can pay them off almost instantly, or maybe a couple days later, or they're very good at paying their bills. So if you're like that kind of person that always pays their bills at the very, 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 very beginning of the month, versus if your bill is due on the 25th of every month, right? But you go ahead and take advantage of it, just pay it off on the first week of the month, then net method is going to be in your favor. Okay? The net method is going to be when you decide to take advantage of that discount because you're good at paying your bills and you're responsible and that you can actually pay it off. Okay? Now, where the gross method is kind of like where you record at whatever original price that they billed you for. And the idea here is that you may or may not be able to pay within those terms, right? Because it's depending on your company, right? Maybe you have other priorities. You may need to pay your employees first. Maybe you might need to pay a loan first off, right? So that's where most businesses, okay, especially smaller ones, when they're not sure if they can afford to be able to pay everything off in a short amount of time. They may have other responsibilities that they may have to attend first. And then if they do end up paying it off within those discount periods, then they would receive the discount without without intent, right? If I paid today and I just happen to fall into my discount period, then I get my discount period. But if not, you have until, X amount of days to pay off your bill. All right. So again, gross method is where you record it at original price. And if you pay on time and within the discount period, then you'll record your purchase discount. But if you don't need to worry about it. You just pay whenever the bill is due. All right. So once again, most small businesses and most common businesses would typically use gross method because of the idea that they may not have enough money to be able to cover these costs right away, especially if you're looking at purchasing like thousands of dollars worth of inventory, right? Thousands of dollars is a lot of money. But if you're looking at $20 here and there, that's nothing, right? But this, we're looking at a grander scale. And think about it too. If, let's say, I had $10,000 worth of inventory that I purchased, right? Maybe that incentive may actually help you out in the long run. If my incentive was at 2% earlier, right? That's $200 I saved right there. But in most cases, like I've mentioned before, smaller businesses, they might not be able to afford that $10,000 right then and there. They may have to wait until they make their proper sales and collect that money to say, hey, I now have enough to pay off your bill. And if I pay within the discount period, then great, I get the discount. But if I don't, I have X amount of days to just pay the bill off. So that's the idea here. One, the net method is you take the discount immediately, whereas the gross method, you take the discount later. All right, so let's go ahead and take a look at an example. So we're going to take a look at gross method first so we can see what it's like to just take a look at a small business that isn't able to pay right away. Okay, so here, example here on February 1st, okay, you purchase 100 coffee mugs on an account from Cuppy's Co., costing $1.25 each, okay? And freight is $100, okay? Terms are 5%, 10, net 30. record this transaction. So once again, we're taking a look at the gross method. So how do you guys think that we should journalize this?
Okay, first we'll put the date,
Mm-hmm.
then the description of the item.
Oh, okay, that will be saved in parentheses. What account would I be using?
You'll be using you'll be using the gross method where you take the discount later. Oh no, no, okay. So you want to know the terms of the 5%, the 10, and the 30?
So here, exactly how we learned in the previous section, how would I journalize
Oh,
purchase of inventory? That's what I'm asking you right now. I'm
how
asking
would
you to journalize the purchase of inventory.
Expense,
Purchase expense, good.
ugh, price it up.
uh, $125.
$125, good.
Oh, okay, I get it. All right.
That would be debit.
Okay. What else?
Freight expense,
Freight expense,
$100.
good,
Debit.
good.
Oh,
Yep. So exactly like Sonia, I think, said, we're going to do purchase expense for $125. Then we're going to recognize our freight expense for an additional $100. And in this case, now I'm going to, because I owe them on an account, right? I made the purchases of these coffee mugs on an account. So therefore, it is a grand total with accounts payable of $225, right? This is the gross method because we're recognizing at full price right now. Okay? So then let's say scenario 1. We decided on February 9th that we're going to make a payment to Cuppy's Co. All right? So in this case, when we're making a payment on the 9th, our terms was 5% 10 net 30. So 9 days later, I decided to pay Cuppy's Co. So in this case, I'm going to recognize a contra account, right? It's called purchase discounts, right? So in this case, if I made my discount period, right? Here, I'm taking a look that I'm taking away 5%, all right? I get my discount. So therefore, I need to make a smaller payment. So how do you think I should actually journalize this? What accounts would I be using? So if I recognize that I owe money, right? And I'm going to recognize that I should be getting a discount. At the same time, I'm making a payment to them. So therefore, I'm going to be using my cash account. However, what do I know about my cash account? Am I paying for the full amount?
No.
No, because I made the discount. I made the discount because I'm paying 9 days later. So therefore, I need to calculate some kind of amount for to display that I get 5% discount. All right? So how would I calculate that and how would I show that?
You would record the purchase, the amount that you pay for the item,
Mhm.
taking away the discount.
Correct. So, in this case, this is where you guys have to also learn. What number am I going to use in order to calculate my discount?
The 5%,
Okay, 5% on which amount?
The total amount.
The total, which one, which total?
the 225.
Okay,
A per,
all right. Now, you're saying that we're going to take the discount off the overall bill, right?
No,
Now,
No, because we're not getting a discount on the freight expense.
Right.
correct. You can never take a discount off of shipping or handling or any of those expenses. Why? Because can you go to the UPS and say, hey, can you give me a discount for shipping this item? They're going to say no because you already know how they charge you, right? They charge you on the size of the item, how heavy the item is, and what the item is, right? If it's something that has like caution on it, they're going to charge you more for it. But in this case, can you ask a discount for shipping? Absolutely not. Same thing. Can I ask for a discount off of sales tax? Absolutely not. So in this case, the only number that I can actually record my discount is going to be on the actual merchandise purchase price. So in this case, I can only take 5% off of my 125. All right? So let's calculate that. How much would my discount be?
$6.
$6.25.
$6.25. So this is how you're going to journalize it, right? In this case, we recognize that we have a grand total that we owe, right? I owe Cuppies Co. $225. However, because I made the discount period, I'm going to pay them less because I deserve that discount. Okay? So here's the rule here that you need to first recognize how much you owe the person in grand total, including every single thing. And then this is where you're going to recognize your purchase discounts. Your purchase discounts, this account right here, is going to be considered a contra account to your purchase expense, right? This is going to decrease your purchase expense because, right, purchase expense are usually increased with a debit, right? Because this is a contra account, it flows in the opposite direction. So in this case, I'm going to credit this account, and this goes hand in hand to the purchase expense. It will decrease the purchase expense. Okay. So here, go ahead.
Recognize that that's a contra account.
What do you mean by that? How do you? What do you mean? What do you mean? How do you recognize that?
Because the contra account is a account of the sub account, right?
It could be a sub account or it could be a main account.
So how do you recognize that this is a contra account?
All right, let's look. The main thing that you can recognize that this is a contra account because it flows in the opposite direction as the main account. If my first account was purchase expense itself, right? That was the first thing that we did. We bought something, right?
Right.
So now if I want to decrease my purchase expense, I can only decrease it by using a contra account. Right here, my purchase discounts goes against my purchase expense. Okay? And just like exactly how I have it here, right? If I debited my account, in order to go against it and decrease my purchase expense, that's where my contra account purchase discounts flowing in the credit location is going to be applied. And this is more right now we're just learning at what these things are, right? It will start gradually making more and more and more sense, especially when we dive into our fictitious business. But for now, know that this is true. If we're making our purchases of inventory as a purchase expense, the one thing that we need to note here is you can't just credit your purchase expense. It doesn't work like that, especially for periodic inventory. In this case, we need to create another account to decrease my purchase expense. So you can title it whatever you'd like. Most common one is purchase, just regular purchase discounts. Any purchase returns, which we'll learn in the next section when we come back from the break. But here, right, we're recognizing that we have a main account. The main account is my purchase expense. All right. And in order to decrease my main account, I'm going to create a contra account. Because in this case, right, when we're purchasing our assets, right, are we purchasing them at full price? If we take a discount, are we purchasing them at full price?
If you take the discount, are you
Yes. If we're taking the discount, are we paying them at full price?
No.
No. So that's exactly why we need to create this contra account in order to reflect the difference. So in this case, right, if I'm going to be taking away $6.25, that means I originally only paid $118.17 for my actual coffee mugs. Because $100 of it is freight expense. Right? So that's how we have to reflect in our books because we also took the discount. Right? Right? So here we have it. Once again, first thing that you're going to recognize is what is your total amount that you owe. You owe Cuppies Co. in grand total a total of $225. However, because we made our discount, right, we're paying within the discount period. Therefore, I don't need to pay them the full $225. I only pay them whatever my discount percentage is after that. Okay, so in this case, I'm only going to pay them $218.75 because I made the discount period. And I'm going to recognize that by decreasing my purchase expense with the contra account for $6.25. Okay? And at the end of the day, my debits and my credits match on both ends. Right? Well then, scenario 2, let's say we didn't pay them on time, right? Let's say I decided to pay on the 15th of February instead, all right? And in this case, I'm making a payment to Cuppies Co. However, my terms is still 5% 10 net 30, right? In this case, did I make the discount period or did I miss the discount period?
You missed it.
I missed it, right? Because I was only given 10 days, and in this case, I paid on the 15th day. So in this case, right, therefore, the terms cease to exist because you still have 30 days to pay off the bill. But if you do intend paying it, but you missed the discount period, all you're going to recognize is you're just going to make a payment for the full amount because you don't get the discount period. You don't get the discount because you missed it. So in this case, I'm recognizing this one thing and one thing only is if I'm making a payment here, I pay for the full amount. And that's it. Right? Any questions here? In this case, we don't need to recognize the discount because we missed it. All we need to recognize is, well, I have to pay for the full amount. Right? Any questions here?
No questions from me.
Okay. Now, here's one thing that you need to know when you have terms, right? Once you recognize that you have your inventory, right? You purchased your inventory, right? And you received it, then you received a bill, right? So that's where the idea where the accounts payable comes from is that once a transaction has happened, right? Which is you received your items and you received a bill. Once you recognize that you journalize that you have your inventory items and you owe another company money, terms only applies when you make a payment to the bill. Okay, so don't get confused here. Okay, it's not something you journalize when you purchase your inventory, right? Because notice this, right? When we purchased our inventory, we purchased it on February 1st, right? Here we're recognizing when we make a payment and what the dates are entailed when we make those payments. Did we make the discount or not? And that's reliant on whether you made a payment or not. Okay. All right, so that's gross method for you right there. Is where you're gonna recognize that you received it, your bill, and this was for the purchase of inventory, and you recognize it at full amount. All right. And then as you gradually go on through the week, if you paid and you made the discount, then you recognize the purchase discount. Or in this case, if I paid but I missed the discount, I'm just going to just pay for the full amount. That's all I need to recognize. Okay. So now let's talk about net method. Okay. In this case, right, same scenario. On February 1st, I decided to purchase 100 coffee mugs at $1.25 each from Cuppy's Co. on an account. And freight, once again, is $100. And they gave us terms 5%, 10, net 20. Now we need to record this journal or record this transaction. Here we're using the net method. Okay? If we remember, net method means that you're taking the discount now. How are you going to journalize it this time? What's my purchase expense? What's my freight expense? And how much do I owe in grand total? All right? Knowing that you're using the net method. So you have to take the discount immediately. So, what are my numbers going to be?
So you're gonna do the $125 minus the 5% upfront.
Mm-hmm.
Correct?
Mm-hmm.
Right. All right. It still comes out to the $216. So you get the you're just gonna take the $6.25 out of the $125 upfront.
Correct. Which is going to be so it's going to be which is going to be 11.1875. Freight, remember we don't take discounts off of freight. So in this case, that's exactly what you're going to say. We're going to take it out right up front. And in this case, we're going to record our bill saying, you know what? We're going to owe them the discounted amount. Okay. However, just because we record it at discounted amount, the idea is that we haven't paid for it yet. We owe them the money. So let's go ahead and take a look at scenario 1 once again, where it's now February 9th. And we finally make a payment to Cuppy's Co. In this case, right, our terms are still 5%, 10, net 30. But however, we've already taken the discount out already. So in this case, we are just going to go ahead and make a straight away payment because we've already calculated the discount already. So in this case, what's my journal going to be?
Debit accounts payable for 218.75.
Mm-hmm. I'm sorry.
And then
Okay, good. And then credit what?
checking.
Yes.
218.75.
That's exactly what you're going to do because you said you were already going to be responsible. You knew when the bill is going to be paid, and you already took the discount before recognizing anything, right? That's the first thing you did. You recognized the discounted amount. So in this case, I'm making a payment within discount period date, and here that's exactly what you're going to do. You're going to pay it off for the $218.75. Okay. Now, well, what happens if you forgot and you end up paying on the 15th of February? Let's say, oh my gosh, I recognize that I had the discount already, but I forgot to make a payment because I was paying 20 other bills prior. I forgot. So in this case, I missed my discount period. All right?
Well, depending on what the terms is. So if you were supposed to pay within 10 days in order to get for that 5% to apply, then anything outside of 10 days, you go back to paying full price.
Correct. So how am I going to journalize this?
So it would be accounts payable for the full price, which would be the $125 plus. So it would be the what, 225?
Okay. Now, accounts payable. What did we originally state that we owe this vendor?
$218.75, but because they paid they paid later 15 days, they paid on the 15 versus within the 10 days, they have to go back to paying full price.
Right, but in my books, I've already recorded at discounted price.
You're gonna have to add back that $6.25. You're gonna have to put that 5% back.
Correct. But in this case, we're going to recognize a contra account. Okay? Because in our books, right, we said that right now I only owe them $218.75. But because I missed the discount period, right? Therefore, I have to create a contra account to recognize that I lost this discount. Okay? Because I was irresponsible and I missed the payment. So therefore, I do need to technically add it back in there, and that's exactly what we're doing here, because in the very beginning, we took that discount out first thing, right? Because we're under the net method. Now, because the bill's going to still reflect you owing $225, but because on our end, we get to journalize it how we please. In this case, I took the discount automatically because I said I was going to pay it off on time. But I was irresponsible, I missed the payment. So therefore, I need to add that money back in there, but I can't just add that money back in there. I have to do it in a way where it's going to show like this, because in my original purchase expense, if you look here, right, I've recorded it at $118.75, meaning it's short $6.25 because the original is $125. So I need to add $6.25 back to my purchase expense account. All right? And I need to add that back into the total amount that I actually owe. So in this case, I need to create that contra account to place it back into purchase expense because I recognized it lower than what it should be. All right, so my purchase expense is now, by adding this back in there, is now $125. All right, and now I need to pay for the full amount of the $225 because I have to pay for the full amount. All right. Right, any questions here?
No, I'm good.
No.
Okay. All right. All right, so chapter review. So once again, we got to take a look at just purchasing inventory in general, right? We got to take a look at what is entailed for the cost of the asset, right? Everything, every single cost it takes to get the asset to your store. All right. We also got to take a look at two different types of tracking methods, periodic versus perpetual, right? perpetual is what we're going to learn after our first exam. Okay, so chapter 5 is extended out to about 5 sections. And today we're going to go over the first 2. So, periodic inventory, that's all that's going to be in chapter 5 and as well as chapter 6. Okay, so dealing with periodic inventory. Once we come back from our exam, that's where I'm going to show you for chapter 7 and chapter 8 is going to be revolving around perpetual inventory. Okay, so once again, for now, we're only on chapter 5, so we're only focusing on periodic inventory. But what I want you guys to know is at least the definition. What does periodic mean? It means every once in a while, occasionally, not so often, where perpetual inventory means constantly. You're always constantly, frequently updating your inventory, okay? That's all I need you guys to know for now. Except for periodic, I want you to recognize when we're dealing with periodic inventory, how do you journalize it? Right down below. We journalize it as if it's an expense. So down below here, I have as purchase expense and freight expense. Okay? Other things that you may need to know here is going to be what are the different types of shipping? How is the shipping handled? Who pays for what? Who owns what? Okay, shipping point or shipping origination or FOB shipping FOB shipping point is where it comes from the seller store to the buyer store, right? Or to the midpoint. That means the buyer is responsible to pay for the shipping. Once it leaves that midpoint and makes it to the buyer's location, which is called FOB destination, then the seller is responsible to pay for the shipping and is responsible to, for the items. Right? We also got to take a look at how discounts work, right? We understand what terms are. And here we looked at what the net method does and versus the gross method, right? Once again, it's depending on when you pay your bill for terms to happen. All right. But this is just us recognizing how a discount works when you purchase inventory. All right. This is separate than selling your inventory, right? Sales discounts are completely separate from this. This is just purchase discounts. Okay. So we're only looking at what a vendor can sell to us and what discounts can be offered based on what the vendor gives to us. Okay, the terms, right? And that's it, right? Any questions for chapters 5.1?
No.
Okay. All right, so let's dive right into the chapter 5.1 exercises. Okay, so here I give you some 4 examples here, and what we're going to do is we're just going to practice journalizing our information and maybe cover a few things. Okay, so let's start with the first one. Right. So here I'm going to ask you to journalize and assume that all purchases were made with cash. So there you go. I'm specifying how you're going to make a payment for these purchases. All right. So on April 5th, right, we purchased 1,000 units at $5 each with the freight cost of $100. So how do we journalize this? How do we record this transaction?
The date 5,
Mm-hmm.
and then we have a freight for a purchase exchange
Good. Purchase expense.
for $5,000,
Mm-hmm.
and then a freight expense of 100,
So therefore, in grand total, how much did I pay in cash?
5,100.
5,100, right? In this case, I specified that we paid in cash. So now again, once I'm going to just have you guys just for now, just practice journalizing. If you would like, you can add descriptions. Just know that you may have to add a few more extra cells if you'd like. We'll practice descriptions if you'd like. So in this case, how many items did I purchase?
1,000.
We purchased 1,000 units, right? And you could say at $5 each. Okay. All right, what about the next time? So the next date here we have is April 10, where we purchased 750 units at $5.75 each, with the freight costing us $75.
So you would date it April 10. Purchase expense would be $43,1250. Freight costs at $75. And then cash. Sorry, I'm using my calculator here.
That's fine. Completely fine. 403, 8, 750.
Yes.
Perfect. Good. And even here, we could say, right, we purchased 750 units at $5.75 each, in parentheses. So, important thing that when we practice journalizing is that the journal is just meant for your accounts, okay? But in this case, if I want to add details to this transaction, I just have to have them in parentheses. Okay. What else happened on April 20th?
First the date and then purchase expense
Mm-hmm.
for 1,200.
All right. Let's look at that again. For how much?
Never mind. Let me see.
$420.
No, that's not right. So what's my total purchase expense here?
Is it $1,200?
1,200, right? Because we're taking our 200 units that we purchased at $6 each. So here, 1,200, right? How much was my freight?
$6. No, $20.
$20.
$20. Good. So therefore, in grand total, how much did I pay?
$1,220.
Good. Right? And of course, my note I could say here is that I purchased 200 units at $6 each. Okay. This will become relevant when we come back from the break. 5.2 when we look at returns, right? And last but not least, we have April 25th. We purchased 500 units at $6.25 each, and my freight cost was $50. So how do I journalize this?
your purchase cost.
So purchase expense.
Expense, it was $3,125 plus your freight was $50, so that's $1,175. I mean $3,175.
And freight expense is for $50. So then you said the total cash that we spent.
$3,175.
3,175. Perfect. All right. And again, I'm gonna make a note that I purchased 500 units at $6.25 each. Okay. And that's how we journalize just our purchases. Okay. Any questions there? No? All right, question number 2. What costs are included when making a purchase of inventory?
All costs to get the items to the store.
Yes, good. All costs to get the items slash assets to the store. Good. That's the exact definition I was looking for. So that can include freight, sales tax, shipping and handling, foreign costs, storage fees. Right? That can also have expedited fees if you're trying to ship those items quickly, right? Okay. Number 3, what are the 2 tracking methods of inventory?
Periodic and perpetual.
Good. Periodic and perpetual. Number 4, what does the net method mean?
Is that after the discount?
What do you mean by that? When do you take it? Do you take the discount now or later?
You,
Up front.
Up front, good. Take good. Right? Number 5 says using the gross method, okay, for a periodic inventory, you made a purchase on April 5th, okay, of 1,000 toys at $5 each, with the freight costing $100, okay, on an account. All right, the vendor gives you terms 5%, 15, net 30. Journalize this transaction. We're using the gross method. So once again, how would you journalize this? Right now, we're just receiving our items. We haven't made a payment yet. So how are you going to recognize this?
just the cost of the items, the $5,000?
Mm-hmm. So purchase expense at $5,000. Right? Right? We're recognizing it at its original price, right? We're not talking about discounted price. We're talking about just recording it at original price. Right? So in this case, because I placed it on an account, what account am I going to be using here?
Accounts payable.
Accounts payable, good, right? We owe money to this vendor for a total of $5,100. Okay. So now continue with the question 5, all right? You decide to pay the vendor on April 15. Journalize this transaction. Let's take a look. Did I make the discount period or did I miss it?
You made it.
We made it, right? We bought it on April 5th. Now we're paying on April 15th. So now I'm recognizing that I'm making a payment to what I owe. So how am I going to reflect this discount?
The amount of the purchase, the $5,000,
Okay.
$5,000, and then you're going to add and then you're gonna put the discount amount. Because you're gonna claim the discount, right?
Yes, good. Your thought process is correct. However, the way that you're journalizing is not correct.
Go account payable.
Right, we're making a payment to what we owe. So in this case, what did I recognize as my total amount that I owe? How much do I owe? We owe, exactly.
Oh, okay.
Now we can recognize, since we made the discount period, we're not going to pay them $5,100. How much are we actually going to pay? Now, your thought process when you were talking about was you're going to take the $5,000 and you're going to recognize the discount. So in this case, what is 5% of $5,000?
225.
250.
55, sorry.
255? What? Sorry.
I got 250.
Oh, shoot.
Or is it?
5%? Oh, wait. You might be wrong. 5,100.
Wait. I might be wrong. Times 5%. Oh, yeah, it was 255.
It's just 250. You were right the first time. All right. All right. So how are we going to recognize my discount? What account am I going to use?
Purchasing discount?
Purchase discount. Excellent. Purchase discounts, right? And we're going to recognize it for $250. So therefore, how much am I going to actually pay?
But wait. Question.
Yes.
Question.
Yes.
Because we don't, so because we can't discount the freight charges, and the freight charges is included in that 5,100. Would we be discounting the full 5,100 or just the cost of the products?
We can only discount the actual price of the product. So in this case, the $5,000, even though yes, it is included. So that's why you do need to note that when you're dealing with periodic inventory, right? When you journalize it, you've already separated it right here. You already know what is your freight cost and you already know what is your purchase price. So in this case, you already know that you cannot discount the freight. So you do have to subtract that freight out from your total amount that you owe.
So
So that's what I'm saying. So given how we're answering the question on number 6, we're answering the question taking the 5% or the 255 out of the total, which is the 5,100.
But the 5,100 includes the freight cost.
Exactly. But then, okay. So because where I'm getting confused is we only should be applying the discount to the 5,000, not the total amount, right?
Correct.
Because the freight cost is included in the total.
Correct.
Am I the only one having a question about this?
Right.
the 2 is 5% of the 5,000.
Is it 2% or is it 5%? It's 5%.
It's 5%. This should be coming out of, according to question 6, the way you're journaling it now, it
Uh-huh.
should be coming out of just the, not the total 5,100. It should be just coming out of the 5,000.
I think
Right.
you
But
guys
in
can
this case, I
the
owe
account,
this vendor
the account.
in grand total 5,100.
Right.
So if I'm paying this vendor, I have to include the freight that I have to pay. I can't pay them two separate checks saying here's for the items that I purchased and here's for the shipping.
Right.
Yes.
So, but when we're journaling, when we're journaling this, and
Mm-hmm.
in terms of putting the items, the freight charge should be included in the itemization of the journal, correct? So that
We
they know that the 5% is being applied to the 5,000 and not the total amount. And but the check, it is still, once the check is issued out, it still come out with the total amount. You follow what I'm saying?
yes. And that's exactly what we did in the very beginning right here, right? We itemized our costs. We
Right.
separated it here.
Mm-hmm.
In our description, absolutely. If that's something that you want to make clarity to, saying I'm only applying the 5% discount off of my total of $5,000, then you may do so.
Okay. All right.
But in this case, that is exactly correct. However, like I've mentioned before, right? When we're making a payment to this vendor, you're not going to send them two separate checks, one for the freight and one for the actual discounted amount. You're just going to send
Right.
them one whole check. So in this case, I'm taking away from my accounts payable because that is that my accounts payable right now. I'm not taking away from that. This purchase discount is taken away from my purchase expense. Okay.
Okay.
So that
So you'll be sending them a check for the what,
full
$4,850.
yes, $4,850.
Yeah.
Yes. Yes. Wait, so let me see. 50. Nope, it'd be 47.
Oh, you just lost me on that part.
All right, so
Because
take.
she
Oh
took
wait,
out
no.
the
I got it. Never mind, I got it.
Oh,
You're right.
okay.
You're right. I was thinking of the 5,000 that you were saying earlier. No, you're right. It is for 48.50. Yeah, 48.50. Yeah. So you're sending them a check for whatever amount that you are gonna pay for it. So in this case, in their books, right? They're looking at 4,700 being for the purchase of inventory, and then that extra 100 is for the shipping. All right. So that's how on their books they're going to separate it, and when they receive the payment, that's what they're going to put on their books. But on our books, all we're saying is we're making the payment. Here it is. This is what I owe. I made the discount, so this is what I'm recognizing on my books because I don't care what they put in their books. That's their business. That's what they want to do. But for me in my books, I want to say, hey, this is what I owe, right? This amount that I owe includes both purchase price and freight expense. But as my diligence as an accountant, I need to make sure I recognize that when I'm dealing with periodic inventory, I'm looking at two separate costs. One cost is the purchase expense and one cost is the freight expense, right? I know for a fact that this amount is going to be for $1,000, right? For $100 of freight, including the $5,000 for my purchase expense. Now, what you could have done here too is you could have actually recognized this, right? If I purchased 1,000 units at $5 each, right? That tells me here, right, that my amount that I actually purchased the items for was in fact $5 each. And then you could have just recalculated from there saying, well, 100 of those dollars is to freight. Okay? And when we take our discount, you're correct here, where we're only recognizing the $5,000. However, this is the amount that I owe the vendor in grand total. I can't change that because that's what I owe. I owe. Cannot change that. So in this case, I'm running a check out to them as a total amount, including the freight. When I did my calculations, I just have to recognize that it is separate. It is based off of just the $5,000 itself. But however, I need to write a check that includes the full payment with the extra $100 of the freight.
And we can also put a note in there in this particular case, on example number 6, that the accounts payable amount includes freight.
Correct.
Just in case we know because we did the book, but if somebody else comes and look at it, there's no question because it's noted.
Exactly. Correct. Good. So I could say paid in full, 5% discount, right, on $5,000 purchase, right? Whatever way that you want to be able to recognize this is up to you. So here, I'm going to recognize right here that I paid in full and I received a 5% discount only on the $5,000 item that I purchased. Okay, I'm not including the freight in my description. I said I'm paying in full, right? I paid the vendor exactly how much I owed them. However, I discounted the 5% only on the $5,000 purchase price. Okay. Good. Okay. Question number 7. All right, it's going to say, using the information from question number 5, journalize the purchase using the net method. So we're going to go back and we're going to re-journalize scenario number 5, but instead of doing the gross method, we're doing the net method. So how would you record using the net method?
So accounts payable would be the 4850.
Okay.
Purchase expense would be 4750.
Okay.
And freight for $100.
Good. Okay. Just like that, right? In this case, we're recognizing using the net method. And how we're looking at it is that we are going to purchase it at discounted price. So we're going to take that 5% and take it out of our total automatically. And we'll recognize it as $47.50. Then we're going to tack on the freight. So then now in our books, we're going to say that we're going to owe them for the grand total of $48.50 with the discounted already included. So you have the discount already and you have the shipping in there included with the price itself. So that's exactly correct. All right. Any questions here? All right. Last but not least, question number 8. What does terms 2%, 10, net 20 mean?
Pay within 10 days and you get the 2% discount.
Good. Pay within 10 days and get discount. 2% discount. Okay, what does the 20 mean?
After 20 days is the full amount.
Okay, so after 10 days, you must pay
After
within 20 days.
So after 10 days, there's no discount.
Right.
So in that definition, they're giving them a 2% discount within 10 days, but then they give them an extra 10 days. Then they have to pay the full amount.
Correct. Extra 10 days. Good, correct. So the terms is if you pay within 10 days, I'll give you a discount. If not, the whole bill is due within 20 days. It's not 20 days extra, it's 20 days. So you have 20 days to pay the bill, but if you pay within 10 days, I'll give you the discount. But if not, 20 days is your amount that you can owe me. That's the length of time that you can owe me. It's exactly 20 days. No more, no less. If you do go extend obviously more than 20 days, then you're subject to get fined, penalties, late fees, all that extra stuff. But in this case, I'm trying to only limit you on just the very basics. But yes, if you can't pay within 20 days, then you'll start tacking on late charges, late fees, whatever percentage that you agree on, interest, so whatever it is. But like I said, that's a little more for an advanced level of accounting. I'm not going to boggle you guys with that. So just understand that you have 20 days to pay the bill. And if you don't, then you're subject to all that other stuff. But yeah, you only have 20 days to pay it. Right? Good job, everybody. So right now it is exactly 10:02. I'm going to call it at 10:05. Go ahead and take a nice 20-minute break and be back at 10:25.